Firm has a tax rate of 22%. Okay. Now we're going to figure out all sorts of things. We're going to figure out A, net capital spending. We're going to figure out change in net working capital. And we're going to figure out operating cash flow. And let's remember that operating cash flow is equal to net income plus depreciation. And finally, the project cash flows are cash flow from assets, which is operating cash flow minus net capital spending minus change in net working capital. We're going to kind of build a spreadsheet, okay? I'm going to, let's see, add a sheet, or I'm going to cheat because I want a black sheet. Okay. Let's call this parameters. You know, the inputs. I'm just going to enter the numbers that we put in. Marketing cost, or marketing research, 100,000. Okay. Historical cost of land, $10 million. Current value of land, what did we say? 20. Oh, one thing I forgot to add. Firm believes that the land would be worth 25 million in 5 years. Land in 5 years. Okay. Cost of building, $5 million. Oh, tax life of building, 20 years. Tax life of equipment. 7, I believe. Project life, 5 years. If I'm not mistaken. I'm anal about formatting. If you don't like it, tough. Do your own formatting. Lost sales units, 500,000. Uh, 868. $500K units, not 500K million. 300,000. Oh, one thing I forgot to add. You believe you can salvage the equipment for 10 million in 5 years, and building can be salvaged only for 200,000. It's probably a building specific to a task. You'll just scrap it for raw material. I'm just making up the numbers. So equipment salvage. Building salvage. Uh, 12%. Sales growth rate, 10%. You need 25% of the sales for the new products in what you want to call working capital. For the old one, what is that? 5 and 10. We got that, we got that, we got that, we got that. Okay. So all of our inputs are here. Now, first of all, we're gonna decide, am I going to use that $100,000 that I've already spent on the marketing research? I hired a company to figure out for me how much I can sell and how much I can charge. It's sunk cost, it's gone, okay? So it's not relevant for project purposes. Now let's worry about let me do another sheet. Let's call this net capital spending. Okay. Oh, insert. I also have year 0. So let's call this building equipment. Okay, on year 0 and land, I'm spending $5 million on the building. That's obviously a cost that's relevant. So that's going to be negative building cost. All right. Same thing with the equipment. How about land? Should I put anything in there? Firm already owns the land. No, it has not. This question has nothing to do with depreciation. I'm trying to figure out period 0 capital spending. Okay. Actually, those shouldn't be negative. These are spending. So should I put 0 for the land because company already owns it? Why? You're nodding your head. Yeah, but no, I don't have to pay for it. But remember the standalone principle in project evaluation. You act as if the project is a distinct entity. If you're using that land, you're effectively getting it from the firm, which is outside of the project. That's the idea over there is the opportunity cost. So that cost is relevant. And the relevant cost is what it can be sold now. Because if the firm didn't give that land to the project, they could have sold it, right? Or you would have had to buy it from somebody else. Hence, current market value of the land is relevant. I'm going to put a total here. So on period 0, we have $50 million of net capital spending. The way we set things up, there is nothing in between.